Attractive crowd we have tonight. Thank you very much. Hi, this is Alan Gassman, and welcome to our presentation today on relationship planning for businesses and professionals. I was just showing one of my favorite videos. It's called Life Vest, L-I-F-E-V-E-S-T. You can see it on YouTube. It's a very, very interesting interaction of people helping complete strangers, which is allowed under the law. You are allowed under the law to help complete strangers, and you may like them more than a lot of people you know, of course. And I'm reminded that the Tampa Bay Lightning are in the playoffs with some team from Colorado. I think it's called the Avalanche. And our next speaker, our 1 p.m. speaker, is a big Avalanche fan. So I wonder if he has hockey sticks behind him when he speaks at noon. And that is Brad Burnett. He is unlike me, he's a wonderful tax lawyer, and he's going to talk about the new rules for disclosure of K this and K that. So look forward to those of you who are still awake at noon joining that. Now, if you're a CPA and you want continuing education credit for today's presentation, then you should have logged in through CPA Academy. If you did, then you will see the polling questions, you'll answer the polling questions, and you'll get your credit today. Those of you who are not CPAs and you don't need the credit, you logged in through our website. You can pretty much ignore the polling questions when we get there. They don't pertain to you. So you can click on the questions box and put in the questions, and we will appreciate receiving your questions. And I apologize, I see most of the questions are, why was there no audio for the video you were playing? And the answer is because I don't know. I apologize. Go ahead and watch it on YouTube. It's really good. Join us Monday, June 20th with Luis Silva, part of the diversity series that Marty Shinkman and I are putting together for the National Association of Estate Planning Councils. This is going to be called Estate Planning for the Latin American Client. And we're going to cover what happens with Latin American limitadas and SAs and other entities that are used in Latin America and Central America to handle this and that. Okay, going to the matter at hand, I put together 3 different presentations that I've given in the past. Each has been 45 minutes to an hour long and has actually seemed longer. So I'm going to just kind of go through some of these, and if you want, I will do a part 2 later on. And when we get into business and financial relationships, they can be very positive and they can be very negative. So the approach needs to be careful. And what I will give you today is a thumbnail outline of different things to pay attention to. And then next week, I'll have one of our law students prepare a formal outline and email it to everyone who has attended this webinar. And one question that comes up is whether you should be doing background checks. Now, when we get a new client relationship, our intake people search the internet, do a background check until we get consent from the client that we can run a background check on them. And one of the main reasons we do it is because it will tell us where all their real estate is, where all their car ownership is, and what their criminal records and judgment situation is. And sometimes, oh, sorry, just starting to share the screen there. Sometimes we will also find other information that we didn't know about and that the client didn't know about. So it will typically cost about $150 to have a private detective run a thorough background check, and it will typically take 15 minutes for them to tap into the public records and get the background check printed and sent to you. When you do it through a law firm, it usually costs us between $25 and $75, but we have to have written consent from the person whose background we are checking. So, and remember the Mark Twain quote, there's two types of people who accomplish things and people who claim to have accomplished things. The first group is less crowded. So another thing that we tell our clients and the people who attend the workshops that I provide is that unfortunately you have to expect dishonesty. Now, you don't have to expect dishonesty everywhere you go from every person. The dishonesty may only be 2% or 1% of the population. But those who know how to make a living being dishonest will come and find you. So as lawyers know, every day we get emails from people who say, do you do divorce work? I have a settlement and I need representation. Or our oil well needs representation. And these emails always have a very small, seemingly inconsistent, or seemingly small spelling error or a punctuation error. And the reason is because the people who perpetrate these crimes en masse know that the more naive professionals will answer if it looks amateurish. And then they go on to say, well, I'm sending this money to your trust account. Then the next thing you know, you get a certified check to your trust account and you need to send a check right away somewhere else. And then you check with the bank and there is no such account and they almost stole money from your trust account. And if they do 100 of those a month, they'll find 2 or 3 lawyers who trip up. So there is a lot of dishonesty out there. Unfortunately, you have to expect it. Sometimes what we do when a client is not sure whether an employee is stealing is we'll have the client send an email to 5 of their employees, including the one that they're concerned about stealing. And it'll say, for insurance and other purposes, we need to go ahead and do some routine polygraph tests. I'm not sure when it'll be, but it'll be sometime next week. Just wanted to give you a heads up. And then suddenly the person gives notice and doesn't come back. And you kind of have an inkling that they were dishonest. Now, something my wife Marcia does when we try out a person who helps us around the house, and for the laundry, she'll put a $20 bill in the pocket of a pair of pants. And we'll know pretty quickly whether that $20 got washed, stolen, or handed to us. So to the extent that you can test people on their honesty, on their veracity, you would try to do it earlier rather than later. Just some ideas that come across. Another idea when you're trying to see who you're working with comes from the Malcolm Gladwell book, Outliers, and the technique that Van Halen used to see if they needed to double and triple check the safety of their equipment. Now, if you were a Van Halen fan or you ever saw Van Halen videos, David Lee Roth used to go and swing hundreds of feet back and forth on the stage. He was jumping on things, and all those things had to be done properly, and he wanted to make sure that he was safe. So what he found was they gave very detailed instructions on all of the equipment and all of the needs that they had. And in those instructions, deep in the middle of these long instructions that the venue was required to follow, was this instruction: there should be no green M&Ms. We want bowls of M&Ms, and we don't want any green M&Ms. And why did he do that? And his explanation was, the first thing I would do when I would go to the venue is I would check the bowl of M&Ms. And let me tell you, if there was a green M&M in that bowl, then they didn't do the other stuff right either, and we had to rewrite it. But we knew from experience that if there was no green M&Ms in the bowl, then all the safety stuff was usually done right because the organization had its head screwed on right. So when you get a new employee, when you get a new relationship, go ahead and give them a green M&M type of assignment. Put a $20 bill in the pockets of the pants. See if they're really going to show up and if they're going to be who they purport to be. And for those of you who don't know who Mark Twain was, he was a successful Broadway actor in the 1950s. And he wrote the book Quatrain Bon Sane, which was a very good book written in the 1950s. So another thing we look at is we find that what they used to call the con man is still out there. And there's people, and they will make deals that they cannot live up to. So you have to check the background and their banking references very, very carefully. And there's the story that we see so often where an experienced business person enters into a transaction with an inexperienced doctor, and the inexperienced doctor puts in the money. And at the end of the situation, the experienced businessman has the doctor's money, and the doctor has an experience. So you just have to be careful of who you're getting involved with. So here's the first polling question. And for you CPAs, you know that you should answer it as soon as possible. And the answer is D. D is in dog. But the question is, which of these are great books? And the first one is How to Win Friends and Influence People by Dale Carnegie, which is an all-time favorite. The second one is Are You Ready to Succeed by Srikumar Rao, which is also an all-time favorite. The third one is Happiness at Work by Srikumar Rao, which is a great book on relationships and how to enjoy your experiences. And D is all of the above. And Brittany, are we getting answers here? Okay, so for those of you who did not get a D in chemistry like I did in 11th grade, the answer is still, nevertheless, D. And once about 95% of the CPAs have answered, we go forward, and here we are. And as Yogi Berra said, you can observe a lot by watching. So my next advice, thank you. My next legal advice is don't be a jerk and don't get involved with jerks. Jerks end up making legal problems and business problems. How do I know someone is a jerk? Well, the best indication for our law firm is that they are not polite to the staff. I have found by experience that if somebody is not well enough groomed to be polite to my receptionist, to my intake person, to my janitor, then they are not going to be polite to me at some point in the relationship. I mean, everybody's entitled to be grumpy, and you can call the person and say, "Hey, is there a did my receptionist just upset you?" No, what do you mean? Why would your receptionist upset you? Well, my receptionist was upset because when you spoke to her, she thought that you were upset with her. And then the client puts two to two together and says, "Oh, I'm so sorry. I did not mean to be abrupt. I'm having a tough day. I apologize." And they may even send her flowers, which I will then take home to Marcia because they're really corporate flowers. But if the client says, "I don't know what you're talking about. Your receptionist is rude." Well, I know my receptionist isn't rude. She's friendly to everybody. So that's a client, that's a relationship, that's a colleague that you don't need and I don't need. And if you're a client of mine, please repel those people because I don't want to have to represent you later when they become a problem. One thing that we do in our law firm is we run psychological profiles on our employees before we hire them. And even as difficult as it is right now to find an employee, we find that if they take the test and they fail the test, that they're going to just take too much energy, too much time, and make too many errors. So, for example, if I'm looking for a good legal assistant or a tax lawyer, the first line, they play to win, they're aggressive as opposed to being cautious and helpful. Guess what? I need someone who's cautious and helpful. I don't need the play to win person in my organization. We've got enough playing, enough winning going on. So people are typically going to be some balance of these two. You're either a player and a winner, or you're cautious, helpful, and risk averse. Maybe my personality is more towards the aggressive one and a little bit less towards risk averse. But the people who work for me, I know I need them to be risk averse so they can catch all my mistakes and they can be careful. And then the second person, or the second personality trait, is you're pretty much either friendly and outgoing and people oriented, or you're an introverted, analytic pragmatist. And it's fine if you're half of each, but someone in my office, we're doing a lot of paperwork. We're getting a lot of details we need to get done right. We need analytical. We don't need talk all day about your weekend. So those two balance each other. And then some people are very flexible, they're impatient, they want to change how things are done. And other people want to follow the rules exactly as the rules were written. They don't want to change anything. So if I'm looking for a great salesperson, I'm probably looking for the first characteristic. If I'm looking for somebody who is going to follow the rules, I need a higher line there. So that's not a match. And then finally, is the person self-managing and they want to make their own decisions, which many of us do? Or does the person like to know exactly what to do and they'll follow the recipe? And for a legal assistant, we normally need someone who will follow the recipe. So this $200 test, which it's an innocuous little test itself. You wouldn't have any idea that it would give you all this information. You send it to the Omnia Profile company. They send you back a report and you know what's going to go on. So anytime that I have hired someone against their advice over the past 25 years, it has not worked out, and exactly what they said would go wrong will go wrong. So I've given this test to some great clients and close friends too, so that we can get to know each other. And it's a very interesting arrangement. So what else are we going to talk about? Well, let's talk about some of the relationships you're in and what to do about it. One is a landlord-tenant relationship, and another is an employment relationship. So the first rule that I give to clients and new lawyers is you have to read the entire agreement. And please don't read it on screen. Please read it. Please print it out and mark the daylights out of that document so that you have your brain working better on it. Cross-index the definitions, which people rarely do on screen, and then think about what's missing from the agreement. It's great to read the agreement, but then go read another agreement that is very thorough and think about what you're missing. Use some kind of a checklist and then make your suggestions. And when I started practicing law, if I got somebody else's lease, it was considered very bad manners for me to redline that lease and send it back with my suggested changes. The only thing you were allowed to do, if you didn't want to be kicked out of the community, would be to write a commentary letter. So nowadays, it's okay to make the red line changes to the lease, and always ask for than you expect to get. For 2 or 3 reasons. One reason is you may get what you ask for. Contrarily, you can't get what you don't ask for, but every once in a while, somebody's in a hurry or for whatever reason, they just give you what you asked for. So that's number one. Number two, what they don't give you is a bargaining chip. You can keep saying, well, you're not giving me this thing I asked for, but could you please just give me this other thing that I'm asking for? And then the third reason for the lawyer is that it demonstrates that I have told the client, hey, you have this issue in this lease. Yes, everyone who leases property signs a guarantee, but sometimes it would be a limited guarantee. So let's ask for it to be limited. Yes, everyone who signs a lease is responsible for negligence that occurs from the tenant, but maybe the landlord will accept just that you'll have insurance that covers negligence. So check the reputation of the landlord. Consider getting a competing proposal from another landlord in close proximity with a similar property, whether you're seriously interested in that other landlord or not, so that you can use that as a bargaining chip. Read the entire agreement. With employees, it's the same thing. With independent contractors, it's the same thing. Read the entire agreement. And when they send you the agreement back and it's redlined, make sure that you compare it in your computer so that you know that they didn't accidentally or intentionally change a sentence or two. I have one client who told me that he will get a long pre-printed form that is completely unreasonable and that he will put that into his computer and take the bad sentences out, put some filler language in so every paragraph kind of looks the same, and then he'll sign it and send it back. And they will be bound by that. So even when a customer signs a pre-printed form, you have to be a little bit concerned that they change something. So you have to hold up each page. What we used to do in the old days is we would hold up the pages to a light so that we could see the differences in the documents. Nowadays, a Adobe PDF can be converted to a Word document, and then you could compare that Word document to other. And for employees, scan a copy of the signed employment agreement and email it to your Gmail account or somewhere else, because every year some employee leaves a client and the client can't find the signed employment agreement and sometimes can't find the scanned copy. And guess where it went? I don't know where it went. The employee doesn't say they have it, but maybe they do. So these are relationship issues. And speaking of relationships, our next polling question: more great books. Which of these books are great? The first one of my favorites, The Female Brain by Luann Brizendine. She is a MD and a neuropsychologist, and she wrote the book, The Female Brain, which is a very, very good book, an interesting book that, as people say, all women and all people who love them should read this book. And I have found it to be very educational. And then she wrote a much shorter book a few years later called The Male Brain. And the cover of the book has a picture of a brain put together with duct tape. And I can agree with that. And then another great book is one of my very favorites by Napoleon Hill, Think and Grow Rich. I have mentioned it before. He wrote this book in the 1920s and 30s. It has been rewritten. So the best answer is all of the above. So that is polling question number 2. And thank you for all your comments. I'm going to answer some of them and I'm just enjoying others. One thing I enjoy about the CPA Academy culture is that people love to add comments. So Brittany, are we done? Good. We're back. So let me just show you the covers of these books. The Female Brain, very, very good book. The Male Brain, a little bit comical with the duct tape, which is falling apart. And then Think and Grow Rich by Napoleon Hill. So, Act 2, relationship issues. Keep your entities separated so that if someone slips and falls in the building, they may be suing the business entity or they may be suing the real estate entity, depending upon what your lease agreement says in state law. Get that squared away and understand what it's going to be and make sure they're both insured. And if they sue both, will they be able to get your intellectual property, or is your intellectual property saved elsewhere? And who's managing all of this to get blamed for it? Hopefully the person who owns all the wealth is not making the decisions, or at least not ostensibly making the decisions. So separate what is today one entity into multiple entities and make sure that the relationships between those multiple entities are at arm's length. And the CPAs have heard of the new Parent F reorganization that allows you to do this income tax free. And then separate your investment arrangements. I had a client who called me yesterday, and he has $2.5 million invested in a real estate fund that just went into bankruptcy. So now he's at risk of having to return what he's received from that real estate fund. And it's a New York arrangement, so I think there's a 6-year clawback. So if he invested in that fund under his limited partnership and he gets sued on the clawback, then the other assets under his limited partnership are at risk. But if he invested through a separate LLC that invested solely in that hedge fund, then his other assets are not at risk. And we learned this lesson very loud and clear when the Bernie Madoff situation happened and clients were chased by the trustee in bankruptcy, or I'll say pursued by the trustee in bankruptcy for significant clawbacks. And that's how I believe the ownership of the New York Mets had to change because of that, or they almost went bankrupt. So next, number 4, make sure that you actually read your written agreements and that you know what they say and that they have the divorce clause. So it's great to say, we're going to form this company and we're going to be 50-50 owners, and I'm going to bring the widgets and you're going to bring the customers, and we're going to sign a lease and we're going to make $1 zillion. I'll get half a zillion, you get half a zillion. But then nowhere do they say, but by the way, if it doesn't work out, do I get reimbursed for my widgets? Are you agreeing to work full time? Will either of us be able to compete with each other? You know, people just don't think about the divorce clause. I could draft an operating agreement in 6 minutes, but if you want a divorce clause, it may be 6 hours. The state of Florida has written the divorce law for people who divorce, but has not written the business divorce law. The business divorce law will therefore say each party will pay $250,000 to the litigator of their choice in order to have 3 years of litigation and then not know what will happen because it will have to be appealed. So, you know, you have a great relationship with your partner. In the words of Benjamin Franklin, if you want to have a great relationship, have a great agreement that defines the relationship thoroughly and all aspects of the relationship. So when I'm reviewing an agreement for a client, I'm thinking not only of the legalese issues, but also of the practical issues. And that's why it's a really good idea to have a practical CPA, a practical business consultant, review these agreements with you, even to have a conference call with the other side and the lawyers for the other side. So commonly I call the lawyer for the other side. I'm not sure how to handle the divorce clause. What do you think is fair? If you ask the other side to be fair, commonly they will be fair. Number 5, relationships. I don't care how much you love them. They should not be driving your car or your boat, because if they get in an accident, you may lose all of your assets. So give that 19-year-old child the car. Put it in her name. Let her lose all of her assets. I don't want to lose all of my assets. Or put the car in a limited liability company. Married couples, you can share everything but the car. Each of you should own your own car or put the car in an LLC and have plenty of liability insurance. Okay. And by the way, I have something on Forbes that says your biggest risk is sitting in your driveway, and it talks about cars. Number 6, I set up a company to avoid liability, and I'm the president of the company. And therefore, when someone gets hurt, they're going to sue me because they're going to say that I was negligent and did not act properly for them. So remember, I often tell clients, I have stock in Walt Disney World. If you trip on Main Street, you can't sue me. But if I'm in charge of maintenance of Main Street and I ignore all those banana peels that are on the street or the slick oil that gets on that street when it rains, then I'm the one who's going to be sued. So don't put your most wealthy client in the line of fire there. Go ahead, sacrifice the ego, and make that wonderful son-in-law the manager, and put them in charge of maintaining those rental properties and interacting with those tenants. Or use a professional management company after you make sure that they have plenty of liability insurance. So that is the management company. Now, for confidentiality purposes, we'll often take an operating Florida company and make the manager a Colorado LLC or a Wyoming LLC or a Delaware LLC, because those states don't reveal ownership or managers. So somebody says, well, who's managing ABC company? I'll go to the Florida Sunbiz website, SUNBIZ, and I'll see who's managing that company. Well, you see that it's managed by XYZ LLC, a Colorado LLC. You go to their Secretary of State website, there's nothing there. At least you have confidentiality. But eventually in litigation, they will find out who the owner is. Who the manager is, and they may sue the manager. And if you want to know something about somebody in Florida, just Google Alan Gassman Sunbiz, SUNBIZ, and you don't even have to go to the Sunbiz website to find a lot of the companies that I'm registered agent of or that I'm a manager of. So you can do that with anyone you want. So confidentiality is kind of out the window unless you're going to use a separate management company. So let's remember that partners are responsible for each other's negligence. And the definition of partner can be very broad. There is an entity called a limited liability partnership. And under state law, if John and I are putting together a rental property and we put it in our joint names, then if he is running a survey over to the architect and gets in a terrible accident, well, we're partners in a partnership. I'm jointly and severally liable. If we establish it as a general partnership under state law, joint and several liability. But if we form it as a limited liability partnership, then there is limited liability. I'm not responsible unless I knew that John always drank and texted while he drove, and I said, I don't care about that, John. Go ahead and drive this survey over to the architect. So be very careful about what you call yourself. I client once in her mid-70s, medium health, and had a goddaughter. And the goddaughter had terrible credit. So the elderly client allowed the goddaughter to use the elderly client's name, social security number, and did a fictitious name advertisement in the that it was doing business as Precious Jewels ABC or whatever the company was. And it was a flea market business. And on Saturdays and Sundays, this lady and her husband would go and sell jewelry at the flea market. And it was going fine until the husband stole jewelry from his illicit girlfriend, who turned out to be a prostitute. So the prostitute got a lawyer and sued my client as owner of the building, of the business, and it was $50,000 worth of jewelry. So they sued my client for triple damages plus attorney's fees. And what did my client do? She died. She got very stressed about it. And then, coincidentally or not coincidentally, she ended up in the hospital with something that she hadn't had before, and she died about 6 months after the lawsuit started. Now, she could have easily paid the $150,000 plus attorney's fees, but it caused her a lot of pain. So think about her, and don't sell jewelry to, don't let anyone who goes around with prostitutes sell jewelry or steal their jewelry. And keep things out of your name. Put them into different names. There's all kinds of neat business entities that we can use to try to keep that at bay. The next issue is the doctrine of respondeat superior. I am responsible for the negligence of my employees committed within the scope of their duties. So, when you need something delivered, make sure you have plenty of umbrella liability insurance on whoever's driving, or call Uber. Call Uber, have the Uber driver, who is a true independent contractor, take your employee with the valuable document to the architect and bring your employee back, so it is not you driving. Make sure that you understand Uber now does deliveries. Use an independent contractor delivery service, not an employee. Make sure you understand you are responsible for what your employees do, but not what your independent contractors do. So even though the IRS says that somebody who you pay as an independent contractor should be an employee, state law can be much more lenient. So for example, I might hire a typist to work specific hours each day at a certain time, and the IRS is going to say that is an employee without doubt, and I may have to pay that person as an employee. But the state of Florida law is much more lenient on what an independent contractor is, and I'm not responsible for the negligence of an independent contractor. So go ahead and use independent contractor agreements when you can, providing in the agreement that the person will be paid as if they are an employee to comply with IRS guidelines. That is one, I think, good idea. The second good idea is don't let the employee drive the corporate vehicle, because then you're responsible not only for their accidents during the time that they're working, but also what they do at night. On their way home, they go to a bar, they drink 6 drinks, and then they go and kill somebody, or worse. So let them do that in their own car, give them a car allowance. You're still exposed when they're working during the day. If you can, and many of you CPAs and lawyers on the call know, you could say, well, this is really 3 businesses. One business is they install pools, but another business is trucks bring materials to the construction site. So why not take those trucks bringing the materials to the construction site, put them in a separate company? Let the daughter-in-law own 20% of that company. Let her manage that company. And then if you have a truck that kills somebody on the way to or from the job site, you don't lose the whole construction company. So those are all ideas. And you might have a better relationship with the daughter-in-law or the son-in-law when you give them something to run. It helps to show that everything is arm's length. Number 10, I shouldn't have to say this, but don't break the law. When you break the law, your employees may report you and make a lot of money. It's called a whistleblower. So please do me a favor, do you a favor, don't break the law. And if you are in a complicated business, and who isn't, have an independent consultant come in and review your legal compliance, because you may have very well-meaning employees who are taking shortcuts to save you time and money, not realizing that they are exposing you to horrific liabilities. And an example is when a medical practice in Florida doesn't realize it should register under the Clinic Act because it has a non-physician owner. And then the healthcare plans find out and say, hey, you haven't been registered for 6 years under the Clinic Act. Would you mind please giving me back every dollar I've paid you in the last 6 years? And the doctor has no choice but to pay it all back. So please don't break the laws, and don't work with people who are inclined to break the laws. Remember the old adage, the person who lies down with the dog with fleas gets fleas. Even though dogs don't have fleas anymore, I think you know that the adage is worthwhile. So I can go on and on and on here, but let's do the third polling question. And this polling question is, which of these items, by the way, the answer is D as in dog. Okay. Which of these items is good for a relationship? A, smiling. B, using the other person's name. C, making eye contact at least long enough so that you know the color of their eyes and they know the color of your eyes. Or D, all of the above. Fido, which is the answer? I mean, if you want to make friends, just follow your dog's lead. They're so happy to see you. They smile. They even hyperventilate. They're so happy to see you. They bark because they know your name, and they make eye contact. That's a good dog, and that's a good friend, and that's a good customer, and that's a good professional. Be friendly. Brittany, how are we doing here? Okay. I have permission to proceed. So now I've got 16 minutes, also known by many of us. Oh, don't forget my favorite F. Lee Bailey quote: anyone who acts as his own lawyer has a fool for a client. Don't be your own lawyer. Don't be your own CPA, or at least have somebody review your work. And especially don't be your own lawyer if you are not a lawyer, because then you are engaged in the unauthorized practice of law. If you are creating legal documents or giving legal advice to others, and then you'll be responsible and your malpractice will not cover it. But more importantly, it's just good to get a second opinion on any important situation. And because of the emotional situations and the blind spots, go ahead and use an independent lawyer, some lawyer who's not so busy doing webinars all the time that he could actually get your work done, and have it reviewed, especially if you're not a lawyer. Your CPA and your realtors are not your lawyer. They are your CPA and they're your realtor. And we've seen people get in trouble because they got the wrong advice. And the most common wrong advice from the CPA is an S corporation will not protect you from creditors because it's a see-through entity. The second worst advice that we see from CPAs is, don't worry, you don't need a lawyer to set up your LLC. I can set up your LLC. Well, that usually or commonly does not have a happy ending. All right, so now I'll go back to the last polling question in a couple of minutes. It's at 1, 2, 4. And how do you remember 1, 2, 4? 1 plus 1 is 2, and 2 plus 2 is 4. So that'll be easy to remember where that was. All right, so now I'm going to share with you a few of the pearls of wisdom that I'm trying to share with the students in my summer course at Stetson Law School on law practice management and professional mastery. I think they asked me to teach it by mistake. I think they meant somebody else, but they asked me to teach it, and I am enjoying it. And of course, I'm always using the Peter Drucker quote, you have to quit something before you can do something else. But I don't know that you have to quit something before you can have better business and professional relationships. So one of the things that I developed was this little balloon chart. A lot of people have liked this balloon chart. I think it's because they think the balloons have nitrous oxide in them, but actually they have helium in them, not nitrous oxide. So you can't have success without a good degree of balance. And what balance is you have a personal life, or maybe no personal life, which is better than a bad personal life. And then you are an executive or a professional, for the most part, for those people attending this webinar. And then you have a clientele or customers. And then you also have the team. And finally, you have the structures, the processes, and the knowledge to make your business work. So in each of these items, you have relationships. If the relationship you have with yourself is a terrible mess, then things are not going to go well for the rest of the picture. These blue things between each balloon, these are ropes. Any one balloon will drag the others down. Any balloon that is rising will be held down by the others. So the personal life relationship, hey, go home, ask your significant other how they can be so wonderful. Thank them for something that you haven't been thanking them for. Smile, enjoy the relationship. Personal life gets better. Professional relationship, learn to like yourself, whether you deserve to or not. Clientele customers, what are they thinking? How can I serve them better? And one thing I ask is, are they my friend? One of my great mentors who I spent at least 100 to 200 to 300 hours with, every client was his friend. And after his funeral, over 10 people went to his house and separately told his wife, he was my best friend in the entire world. I will miss him so much. Now, did he do that because he could make more money from these clients? Absolutely not. He took care of everyone, even the clients that were not friendly or that were not his friends. But did he enjoy his profession more? Did he get more cooperation? Was he listened to better because they were his friends? Absolutely. And did he receive more referrals of like-minded friends of friends? Absolutely. So many people, so many newer professionals don't understand what it takes to be a friend and what it takes and what the advantages are to be a friend and what the responsibilities are to be a friend. So think about that. And then for many of you or for us, what's more important is the relationship that I have with my referral sources, the relationship that I have with a CPA who shares a client with me, who shares the experience of helping a client, who shares the concern that a client may be having an alcohol or drug problem or an abuse problem. So, part of this to have a better relationship is to want to and to think about how to. And books like How to Win Friends and Influence People, written in the 1930s, that my Stetson students are reading and learning about, give everything you need. So it's just a matter of, are you going to do it or are you not going to do it? And if you're not going to do it because you really don't like people and you don't want to have any friends, that's fine. Just understand that your competitors may look at this differently. And then there's the team. Gallup poll did a survey of employees to find out what was important to employees. And there's some surprises in the survey. One of the surprises was that the person wanted to know that their supervisor cared about them. Not only was a good supervisor, not was friendly, not was instructive, cared about them. And a second one was that they felt that they were helping people in their job. So we can remind our team that we care about them and that we're working together to help people. And we can give people structures, processes, and knowledge so that they can have a better relationship. And the other thing that the Gallup poll found was in the top 10 of a happy employee was, I have a close friend in the office who is the best friend I have in the office, that they didn't feel isolated. So it's good just to make sure that your employees are socializing, that they are helping each other, that they are using a team approach. And after COVID, when we were all separated and no one was speaking to everybody, it seemed like we could all be sterile. And they're going to be less likely to leave you if they know that you care about them, if they enjoy you as a person, and if they have friends in the office. So those are the balloons, and you may say I'm full of hot air. Maybe I am, maybe I'm not. The other test that we give our employees, and that pretty much over time you can size up in a person to enhance the relationship, is based upon the Catherine Colby A scale. Catherine Colby is a well-respected, at least she's respected by me and many others, industrial psychologist. Her father was a very famous psychologist, and she developed a very simplified test. And probably you get the same results here as you get in the first test I showed you, the Omnia Profile, but it's simplified. It's $49.95. You can go on the internet to her website and put in your credit card and answer some questions. And she will tell you whether your leading characteristic is that you're a fact finder, or you're a follow through, or you're a quick start, or you're an implementer. So if I lead in fact finder, I want to know about everything. I want to know all about it. I'm going to study it. I'm going to be thoroughly understanding of it before I take action. And if I'm a follow through, if I lead and follow through, if that's my highest, then I like to finish things. I'm not apt to go want to do 6 things at a time. You give me a job, I need to finish it. And if you interrupt me and say, no, don't do that, do that, don't do that, do that, that's not going to work. And the next characteristic is the person a quick start? I lead in quick start. So my mode of operation, my mode of thinking is, oh, let me look at this. Oh, that's nice. How can I change it? How can I make it different? How can I make it better? So my inclination is to look at the facts until I decide how I can make them better. And what I need to surround me are people with higher fact finder and higher follow through, because I love to look at things, analyze them, learn about them, and then start them. Do I want to finish them? I want to finish them, but I don't lead in that. So one thing that Catherine Colby says that we found to be very, very accurate is if there's more than a 3-point difference in any two people in any characteristic, then they will have a personality conflict. So for example, if I am a 6 fact finder and my wife is a 2 fact finder, then I'm always trying to figure out what's going on, and she doesn't care about what's going on. If she's a high quick start, she says, hey, let's go on vacation. And when we get there, we'll decide where to stay and we'll buy the clothes we need. Let's go have some fun. Meanwhile, the high fact finder is saying, wait a minute. First, we need to see if it's safe to go. Then I want to know where I'm staying every single night. And I want to know what we need to bring. I'm going to need at least a week to pack. And who are we going to meet when we go there? So that's where your team needs the balance. But when I meet with a client, I pretty much know by the end of the meeting, is this client a high fact finder or more low? Is this client a follow through? That you find out a little later. Are they a quick start? Am I having a hard time keeping their attention? So, I'm squeezing hours of knowledge, hours of experience into minutes here, but trying to get to know the other person, because they're not irresponsible. They have attention deficit disorder. That's not irresponsibility. That's a tendency. And they're not stubborn. They're not stubborn and they're not obstinate. They just have a hard time changing direction. And they're not slow. They're not unintelligent. They just study things so carefully and they can't see the forest because they're so busy looking for the trees. So once you know your team members, once you know your clients, once you know your referral sources, then you are in a better position to act efficiently and effectively and to get the helper's high when you help people. I started the webinar with a YouTube video called Life Vest, Lifevest, which is just a cute little 6-minute video about how a bunch of people in the video all help each other. And at the end of the video, the guy who helped someone at the beginning gets helped at the end. If you help people, good things happen in the universe. When I was my first week of practicing law, my first client looked at me and said, let me tell you something. What goes around comes around. So in this negotiation that I'm in the middle of, the other party forgot to ask for something that I know they're going to want later, and it's going to cost me money later. So you need to reach out to the lawyer and say, hey, you forgot to ask for this, because I don't want to have them humiliated. I don't want to have them embarrassed. And I know that if I'm fair to them, the chances are that they will be fair to me. So I thank Larry Miller in 1984 for giving me that lesson, because I've relearned it many times since. It's absolutely true. So we'll come out later. We'll do part 2. I'll answer a lot of questions later. Right now, I want to introduce a friend of mine, a friend who we met on the internet because we're both presenters and we're watching each other's presentations and enjoying each other's presentations. And I have stole more material from Brad than Brad has stole from me. I think Brad is very well aware of that. And even though Brad is a Colorado Avalanche hockey team fan, I have invited him here today to talk about the technical issues that we are having with S corporations and partnerships and reporting for S corporations and partnerships. And let me also mention that Brad and his wife came to Clearwater Beach, and Brad came to my office and we met with each other for about an hour, and it made a difference for me to get to know Brad, and it also gave me a lot of enthusiasm and a lot of confidence for the exercise program that I am on and for enjoying what I do for a professional. So these types of friendships, I think, are very important. Brad, anything you want to say about relationships or the Colorado Avalanche and the probability of them losing to the Tampa Bay Lightning before we go into the matter at hand relating to S Corp and partnership K forms?
Well, Alan, thank you for such a generous introduction. And then you went off the train track there when you talked about the Avalanche losing to the Lightning. But I see that you have hockey sticks behind you, and all I have is a Hampton Inn room in Rogers, Arkansas. So you beat me there. But I just want you to know that what happens on the ice is what counts. And also, you just gave a terrific program that I thoroughly enjoyed. Thank you for that, on relationships. And you know, when I met you in Clearwater, was a pleasure. And so I spent that vacation working on the outline I'm about to teach, and I'm in big trouble with my wife. And I wonder if you have any relationship advice for me on that.
Just do exactly what she tells you to do for the rest of the day. Apologize often and buy her a gift. One of those things might work.
Gee, thanks. That's great advice. But it seems to still be on the table. I mean, in other words, it doesn't just last a day, but at some point it'll clear up, I hope. Well, thank you, Alan. So today we're going to talk about schedules K2 and K3 and how for 2021 partnership and S Corp income tax returns, they blow those forms out of the water. Let me explain. And by the way, this is a bit of introduction to the topic today, in that we have about 30 minutes plus some QA. I'm going to give a more deep cut on this topic for Lineberg Information Services in a webinar. It'll be a 2-hour program coming up on June 24 at 2 o'clock Eastern time. Today we're going to get as far as we can and open up the awareness of the issue. Now, what today is not is a fishing expedition into international tax. And what this course is for our next half hour or so together is a focused look at the K2, K3 for about 99% of us. And by that, I mean a United States partnership with United States partners. And so today I focus upon domestic, meaning United States, partnerships and S Corps with wholly United States operations, income, assets, and owners. Now, there's a whole other side to the K2, because this K2 thing is all about reporting items of international significance. But today we're going to take a quick look here at the scheduled K2 and K3 for wholly domestic U.S. partnerships or S Corps. Now, what does that mean? It means no direct owner is a foreign entity or individual. There's no foreign financial activity. There's no foreign taxes paid or accrued. And there's no ownership of assets that generate foreign source income. There's no foreign taxes paid. Also, there's no United States or foreign C Corp partners. And then no indirect partner is a foreign partner. Now, what's that mean? Well, of course, a partnership can have a partnership as a partner. And if that partnership that's a partner is a foreign partner, then it's not wholly domestic. Anyway, if any of your owners are foreign, then it's a whole nother bucket of worms. And of course, the K2, K3 then is also required. Anyway,
so Brad, let me interrupt you, because we have a lot of laymen who tuned in for my first hour, and they're wondering whether this is something that they should watch. So an S corporation is a company that makes a special election under the Internal Revenue Code so that its income and deductions pass through to the shareholders. The company normally doesn't pay any tax. The shareholders pay the tax, and they get a K-1 form, which tells them what their share of the income and deductions of the company were. When you have an entity taxed as a partnership, then it works in a very similar way, and that K-1 form applies. You could have a limited liability company, which could be taxed as a partnership, could be taxed as an S corp, or could be taxed as disregarded. So Brad, I know what a K-1 is, and I think most people on this talk know what a K-1 is. Let's just go to the very, very basics so that my grandmother could understand this. What is a K-2? What is a K-3?
Okay, that's terrific. Thank you. And you did ask me to talk about that. Let's do this. So for starters, as Alan says, we're talking about today a United States company, and we're talking about one that's structured as either a partnership or an LLC, taxed as a partnership. And we're also talking about an S corporation, which is a type of S corporation whose income and deductions, just like sort of with a partnership, pass through to the owner. So it's a liability that typically may give limited liability, as you mentioned in your prior program, to the owner. And there is an entity, and there are entity level activities. And at the same time, for tax purposes, the income and the deductions flow through to the owner. Now, the owner, whether it's an S corp shareholder or a partner in a partnership, that owner will receive something called a K-1, which is a statement of that particular owner's share of income and or assets, deductions and so forth, that are that partner's or shareholder's share of things. Okay, looks like a polling question's popped up here. Alan, did we intend for this polling question to pop up? Apparently that we did. Very well, hey. Okay, so while the polling question's going on, a K-1 says, here's your share of income and deductions. And that's all that we've typically had. So now the IRS came along for the 2021 year for the very first time and said to us, oh, by the way, you also have to report international items. And that's what this new K2, K3 thing is all about, as my next couple of slides will show. Hey, Alan, does that work? Yeah, I can't hear you if you're talking. Okay, cannot hear you, so here we go. So all of that said, what we're worried about today is the United States company, the United States owner, and United States operations. That doesn't get tangled up with anything as far as foreign activity goes. That's it. That's what I mean by wholly domestic. So typically, your partnership and your S corp actually do report a K-1 share of income or deductions to the owner. We're used to that. We've had that for decades. But then IRS comes along with this newfangled K2 and K3, and they say these forms have a special purpose of reporting items of international significance. Now, at first, all of us thought that, I'll give you an example. Let's say a little flower shop in Laramie, Wyoming. My older boy attended college at the University of Wyoming, And Laramie is this little town in the wind-blown Wyoming plains in the mountain region. Well, there's a little flower shop, and it only sells to U.S. customers. It has no international income activity. It has no international foreign taxes paid or anything like that. And so the little flower shop says, why do I care about the K2 and K3? Because I don't have anything international. And so the IRS says, well, you do have to care unless you jump through hoops to prove that you meet an exception for filing. Well, why would the little flower shop in Laramie, Wyoming have to care? Because maybe one of its owners had some broker that got him into some foreign investment, paid some foreign tax, and now that owner, outside the scope of the partnership or S Corp operations, has to figure the foreign tax credit on their income tax return to prevent being double taxed by both the United States and that foreign country. So now our U.S. domestic partnership has to do what? Or our S Corp has to report certain information to help the partner or shareholder make sure that they do not get double taxed. And put it this way, there's a lot of complexity to this. Anyway, so today we talk about the solely domestic, the little flower shop, or maybe the little car repair shop that sits in Winter Park, Florida, that has no international owners or business or something like that. Or maybe the, who knows, accounting firm in Blackwell, Oklahoma, or something like that. And so the little flower shop in Laramie, Wyoming says, why do I care about international? I don't have international. But Horace would tell us, for it is your business when the wall next door catches fire. Because IRS says you have to care. So let's all gather around the campfire for a story. Once upon a time, prior to the 2021 tax reporting year, in other words, the 2022 tax season we're in now reports 2021 activity. Prior to the 2021 year, partnership and S Corp income tax returns were in orbit as we knew them without schedules K2 and K3. And then in July of 2021, IRS introduced schedules K2 and K3. But they said, hey, if you're purely domestic, solely United States, no foreign activity of any variety, no foreign owners, then you don't have to care. And so the tax community widely read the above to mean that the partnership, if it didn't have international activities or owners, that it need not worry about the K2, K3. We said, that's nice, they have a new form, I don't care. But the fact is, what did we not see in those original instructions? Because what IRS did, they came along in January of 2022 and they go, everybody has to care unless you prove that you don't have to care. Well, wait a second, IRS, that's not really what we all read the first time back in July when you announced the new form. And IRS says, yeah, if you have a partner or shareholder who outside of the scope of this pass-through entity paid some foreign taxes, then the information generated by this partnership or S Corp will come into play when computing whether or not a foreign tax credit is available and how much is available to the owner, even though this partnership didn't do any foreign tax activity. Well, in response, Alan, to the IRS's broadened scope of the K2, K3 filing obligation, we, the tax community, came up with a fix. And we said, if we go talk to every owner and verify whether or not they need the information from the K2, K3 to prepare the foreign tax credit form, and if we find out from everyone that they don't need the information, it looks like we don't have to file it. And so then the IRS, after the tax world went ballistic, came out and said, oh, yeah, we realized that we pulled a fast one on you when we changed the rules at the last minute. Tell you what, we'll give you an escape hatch. Now, I came up with what I call Fix A, which is an escape hatch for filing the K2 and K3 for the year 2021. And then IRS came out with what I call Fix B. If you look it up on the IRS website, you won't find Fix A or B. It's just my nickname for it. But here's the catch. If you don't qualify for either Fix A or Fix B, then you must file the K2 and K3 for 2021. So what IRS did, at first they said, don't worry about it. Then they go, oh wait, tax season starting. Now you do have to worry about it. We all thought, what? We didn't see this coming. So IRS artificially created a crisis, and then they seized the moment to ride their pony through town to save us all from it. They're like, we'll save you from the crisis we just artificially created, and they gave us Fix B. Now here's the big question. So if you have a partnership or S corp, the question is, why does IRS say that we need a K2 or K3? And IRS says, well, you know, in the past, for the year 2020 and prior, you had to prepare the schedules K and K1, which reported to the partners their share of income and deductions. And if there was anything international activity-wise, it had to report it in a supplementary statement to the K1 in a hodgepodge white paper, willy-nilly supplemental disclosure. The K2, K3 replace those old white paper, willy-nilly hodgepodge disclosures and give them a standardized format. Okay, fair enough. We could see that as a step forward for humanity. However, it's just the way that you introduce it to its IRS. You didn't tell us we had to care until January when taxes had already started. The tax software companies weren't ready for it. In fact, IRS wasn't even ready for it because you can't e-file a K2, K3 until later dates. And so it's just a big Chinese fire drill, or whatever you want to call it, a big runaround to actually get this thing set up and running on time. And so the IRS came out and said, look, we're going to give you actually a break for the year 2021 where you don't have to file these if you meet the transition relief. Now look at number 5 here. It also, these K2, K3s help IRS to select someone for exam. Now I have what I call Fix A and Fix B. If you meet either one of these, then you actually meet an escape hatch for being off the hook to file the K2 and K3 for the 2021 year. Now Fix A, it comes from FAQ 14. If you want to find that, you can go on Google and type in IRS K2, K3 FAQ, frequently asked questions, and you'll find all the FAQs. Then Fix B, which IRS came along with later after the tax world went ballistic. And of course, they said, oh, here's another fix. If you meet Fix B, as I call it, a 4-prong test, then you're also off the hook for the transitional year. So let's first talk about partnerships and partners. And to further answer Alan's question, usually a partnership will file Schedule K with its income tax return, Form 1065. And it's the summary of all the items that are going to be allocated among the partners. So here we have Schedule K2, which is brand new for the 2021 year, which is a glorified extension of Schedule K, and it reports only items of international significance. In fact, it's only 19 pages long, if you can believe it. And then there's Schedule K3, which is a glorified extension of Schedule K1, reporting items of international significance, and it's only 20 pages long. So as you can see, there's 39 new pages that IRS dropped on the tax world like a nuclear bomb in January of 2022, and they said, yep, unless you can prove you meet an escape hatch, you must file these. Now, here's an interesting thing. If anybody's listening to this call as a tax preparer, you know that you enter items into the tax software, and then the tax software crunches it up and spits out the form, and off we go. Well, so there's an odd thing going on here. If the partnership or S corp itself actually pays some foreign tax, the software is saying, we want you to enter it twice. Well, you know, that's counterintuitive to actually enter something twice. I mean, you get this creepy feeling like, if I enter it twice, it's going to count it twice. Well, no, you actually enter it once and then a second time, and each has a separate purpose. The first time you enter it is so that you can report the fact that the entity paid a foreign tax or accrued it, and that reduces the basis of the owner in, for example, their partnership interest. The second time you enter it, it's information that's provided on the K2 and K3 so that the actual partner knows how much foreign tax credit they can take. So this K2, K3 is really a horse of a different color. It's different than really what we've ever seen before from a reporting perspective, given the way they want us to go about it. Okay, fair enough. So, as Alan asked at the beginning, what are the basics of partnerships and S corps? Well, let's take a little bit more and take a look at this. So, with a partnership, you can have any type of owner, no restriction. With an S corp, you cannot have certain types of owners. So, for example, with an S corp, no foreign owners. With an S corp, no corporate owners. And so, since fewer owners can play the game with S corps, well, fewer owners can get involved with international activities in complicated ways. So the K2s and K3s for S corps are simpler, but for partnerships, by comparison, they're wide open, complicated. Now, if anybody's listening here and they're a business owner or a layperson, well, put it this way. For your partnership or S corp return, you need somebody preparing that understands it. And if you're a tax professional listening to this, I don't have to tell you that the old days, well, we can kiss them goodbye. You know, Alan, it's a little bit like the old days, and I can't trash talk because I know that'll backfire on me. Trash talking doesn't pay. We all know this. But in the old days, the Tampa Bay Lightning won 2 Stanley Cup championships in a row, and now they're going for their 3rd. But now they have a new opponent, the Colorado Avalanche. And the question is, are the old days over? I guess we'll have to see how it plays out. But the fact is, it was okay in the past to have a preparer that didn't understand the basics of international tax. Well, now, if you file the partnership or S corp income tax return, there has to be some basic understanding of international tax. And if not, well, it'd be like a dive off the diving board that belly flops, and that's painful. In other words, we've got to have some understanding of the international tax rules anymore to push out to the IRS and to the owners tax reports that make sense. You see, 2021 is the only year for transition. After that, in 2022, we absolutely must push out the K2, K3s. So the old days of the flower shop in Wyoming saying, I don't care about international, well, going, gone, as they say in baseball. And so here we go. Why do we care? The flower shop in Wyoming says, why do I care whether I file K2, K3, or not? What are they going to do? Put me in the stocks and whip me? Well, there's 5 consequences, really, if you're supposed to file it and you don't. So these new forms, remember, IRS says you must file them unless you prove you meet an exception. Well, if you don't prove you meet an exception, you have to file it. And if the return is late, incorrect, or incomplete, then there's a nasty penalty because they accuse you of not filing the partnership or S Corp return. And that's $210 per owner per month, not to exceed 12 months. And class, that's about $2,500 a pop per owner. If it goes a year, that's expensive. And then the K3, it's an information report. There's separate penalties for not giving that to the IRS and also for not giving it to the owner. It may cause trouble because a partner may later come to you or shareholder and ask for the information, at which point now the preparer has to go dig it up. It's not that efficient. Also, it may cause the owner to have to file a special form on their income tax return form 8082, a so-called notice of inconsistent position, if they don't get the K3 when they're supposed to. And besides that, IRS could accuse us of never having filed the partnership or S Corp return at all because it was incomplete. And since it was incomplete, IRS loves to argue that it was never filed. And then IRS forever gets to come back and open it up for IRS exam. So here's the first penalty that can happen, $210 per owner per month up to 12 months. And then there's the information reporting for not giving the K3 to the IRS. And then this is the next slide. There's the payee statement for not giving the K3 to the owner of the S Corp or partnership. And this just gets expensive. In fact, let me ask you a rhetorical question. Does anybody know who originally wrote and sang the song Susie Q? Now, I know that Creedence Clearwater Revival covered it, but that's after the original guy sang it for the first time. Anybody tell me, Alan, do you know who sang this thing for the first time? Who wrote it and launched it?
You don't know, sorry, don't know.
Well, let's see if the audience can come up with it. But the fact is, it's an original Southern blues guitar, rockabilly type song. And it says, Susie Q, I love you, I love the things you do, and so forth. Well, anyway, Susie Q LLC is a 3-partner, wholly owned U.S. LLC in the Bayou of Louisiana. And it has 3 partners. But it doesn't keep up with the treating out on the houseboat. It doesn't have internet, so it doesn't know about the K2, K3, and files the return without the K2, K3. Okay, did anybody get it? Well, the original guy that sang Susie Q, his name is Dale Hawkins. And if you want to listen to a real nice original tune, just YouTube Dale Hawkins Susie Q. It's really a treat. And the guitar is badass. It's really good. All right, so that said, Susie Q doesn't file the K2, K3. And now look at the monetary penalties. This goes on for a year. And what's the price tag? $10,920. Whoa.
Wow, that's a lot.
So how can we get relief in the Red Cross relief tent? That's the question. Well, this ladybug right here is saying, oh, the leaf is wet, and oh, I have to go uphill, and all this moisture is on my back, and it's hard work, and I've got to grind it out. That's true. But what the IRS says is, hey, ladybug, you got to keep grinding because you will not get the penalty relief unless you make a good faith effort. And by that we mean change your systems, processes, procedures. Alan in his prior program talked about processes and procedures and how they have to be in balance with everything else. Well, because of this new K2, K3 thing, they say if you don't change your practice checklists and so forth to gather the information from the partners to see if they need the international information, then you'll get the penalty. In other words, Ladybug, you got to grind it out. We're not going to cut you a break if you don't try. So the little flower shop in Laramie, Wyoming, well, guess what? The wall next door has caught fire. And you do have to, if you're going to take an escape hatch for preparing the K2 and K3, and I know you don't have international activity, I understand that, but you still have to push the form out unless you prove that you went through the work, the due diligence, to prove you don't need it. In fact, Alan, check this out here at number 2. They want the partnership to modify the partnership or S-corp agreement, partnership or S-corp, or governing instrument to facilitate making the owners share the information with the pass-through entity to tell it whether or not they need the information, which then determines whether or not the entity has to push out the form with its income tax return. Now, the IRS says the effort made, reasonableness of assumptions, and size of the partner that the information was not obtained from play into whether the ladybug tried hard enough to climb uphill. In other words, did you do enough work to be reasonable by not supplying the information to the partners? So you have to do something. The ladybug cannot just pull over and take a nap. So let me ask you this. What are the reasons to file the K2, K3, even if not required? Now, I have a little bit to go, and I think I'm going to make the call to just finish it here, and then I'm going to be very happy to look at the questions and address as many as we can. So, seeing the harsh consequence of not filing these new forms, even though we're on our early going of our learning curve on them, why might you want to nonetheless file them this year? Well, first, if any partner comes along after we file our income tax return and says, I need the information, then you'll have to supply it, which won't be the most efficient thing in the world. It also removes the need for the partners to file a so-called 8082 notice of inconsistent position. And so if the partner does not get a K3 when they need one, they have to make up a story about what the K3 should have said and report that made up story on the income tax return, and they have to do that with a Form 8082. This prevents the need to do that. Also, if you prepare it this year, even though maybe you have an escape hatch, you can jump on the train early, because a year from now, the K2, K3 is required of all of us anyway. So it may be that you can file your pass-through entity income tax return without the K2, K3. However, IRS says that if some partner or shareholder comes along and asks for it later, you do have to provide it for them. And as Joseph Fort Newton would tell us in the 19th century, a duty dodged is like a debt unpaid. It's only deferred. And we must come back and settle the account at last. Now, here's the 8082. So if you don't get a K3 or a K1, you're supposed to file this and tell a story about what you didn't get that you needed to get and now what you're reporting. Or if you get a K1 or K3 that you disagree with, you also attach this and say, they told the wrong story, I'm telling you the right one. Anyway, this gets attached to the owner's tax return. And so that's how that works. And so now I want to share with you quickly, what is the transition relief? Because this would get you off the hook. So drum roll, please. All right, this is the transition relief. There's two ways that you're off the hook for filing the K2, K3 this year. One of them is to meet all four requirements of Fixed B. No foreign owners, no foreign financial activity. Last year, you did not provide any foreign information to anybody, nor did they ask for it. And this year, nobody is requesting it. Fair enough. Now, if you meet that, you need a checklist to indicate that you met it. So I'm going to give you an example. My older boy, Miles, who's 36, who owns a bicycle shop on Lookout Mountain, Colorado, that overlooks Denver. It's just where the mountains start there, just above Golden, Colorado. And he has a bike shop. He only sells United States customers. He only sells United States manufactured bikes. There's nothing foreign. He's not a foreign person. I should know. I signed his birth certificate. And I'm a U.S. citizen, as far as I know. His mother is. And all of that said, he's a U.S. guy. There's no foreign activity. There's no assets that generate foreign income. He didn't ask. You see, I'm his dad. I do his tax return for free and his books for free. Of course I do. And so he didn't ask me last year, nor did I report anything foreign. And he hasn't asked for it this year. He's too busy repairing and selling mountain bikes. Okay, that's great. What's the result? There's no K2, K3 required for 2021, but we have to document the file. So I have to go to my son. I say, will you initial this checklist that says all this is true? And he says, Dad, I'm working. I said, I can see that. And I appreciate it. You're a good boy. But please, can you just initial this? And then I've done my due diligence, because the ladybug has to put out some effort to prove that I don't have to file the K2, K3 for 2021. He goes, okay, Dad, and he signs it. Okay. However, we only dodged the bullet for 2021 because the K2, K3 are required for 2022. Now that was fix B. It comes from FAQ 15. It's not that tough. You can read it in the FAQ and you'll see what I'm talking about. Then there's fix A, and this is where you meet any one of these 4 prongs. This one's a little more challenging. That's fine. I'm just showing you technically. Really, between fix A and B, you have 5 escape hatches that are possible for filing the form this year. Okay, that's great. You can read all about it to your heart's delight. Now, let me ask you a question. Who must file K2 and K3? Well, that's anybody who doesn't meet an escape hatch. For example, the entity is formed under the laws of a foreign country, or it's got a foreign owner, or it's got foreign financial activity or foreign tax paid. Or last year you reported foreign tax information or somebody asked for it, and this year somebody asked for it. Well, now you're on the hook to file. Now, what if you're not clear about whether you should file? Well, I'm going to quote Teddy Roosevelt. In the moment of decision, the best thing you can do is the right thing. The next best is the wrong thing, and the worst is not to do anything. If you're not sure, well, I got an old saying in my practice, and that is, if in doubt, fill it out. If in doubt, send it out. So now you might be saying, wait a second, I filed my 1065 partnership income tax return or my 1120S without the K2, K3, and I don't think I met an escape hatch. What do I do now? Well, you go back and file an amended return or a superseding return, or you can sit tight and argue the insanity defense. And I'm not really sure how that's going to work because it's not on the list of the relief in the Red Cross relief tent. So all of that said, go back, file the return again, attach the form. Now, I've got one more major thing here to talk about. And Alan, perhaps you've heard the old saying, look what the cat drug in. You know, we're sitting around and we're having a happy day, and all of a sudden, here comes the cat that's drug in something from the backyard, and we're like, ooh, that was best not drug in the house. Well, you see, we're paying all this attention to the K2 and K3, but something else has surfaced now that we're paying attention to international activity. Now, there's an excellent article here by a gentleman, John Samtoy, CPA, out of the Los Angeles area. And it's a good read. This is a live link right here. Click, click. But here's what he says about verifying partners. You, as a United States partnership, and this is not for S corps, it's just partnerships, must go to every owner and find out in writing whether they're foreign or United States. You must verify their status as foreign or US. If they're foreign, every US partnership has to go to every foreign partner and get a W-8 or W-8 equivalent. Why? Because on foreign partners in US partnerships, there's a withholding obligation of 30%. But if you file the proper W-8 or equivalent, it may go to lower than 30 by reason of a tax treaty, or maybe no withholdings required. Without the W-8, it's full bore withholding, and if the partnership doesn't do it, they're liable to the IRS for it after the fact and might not be able to recover it from the partner. And the other deal is W-9. Now, you and I know W-9s. For example, if Alan's law office hires an independent contractor to fix the roof or something, I don't know, they might get a W-9 from them to get the declaration, I'm not subject to back withholding, here's my name, ID number, so you can send me a 1099 and such. That's great. We know the W-9 as that. But class, there's another purpose for the W-9 that most people are not aware of. A US partnership must get a W-9 from every US partner. Now, where do I get this from? From the W-9 instructions. What you see here in the blue, green, and red is a cut and paste from the W-9 instructions. Here we go. If it's a US partnership conducting a US trade or business, or a foreign partnership conducting a US trade or business, it must withhold tax under Internal Revenue Code 1446 on any foreign partner. But if a W-9 has not been received from every partner, the tax law presumes that the partner is a foreign person. Thus, a US person that's a partner must provide a W-9 to avoid withholding. Now, this is not required for S corps, but it is required for, of course, US partners of US partnerships. So let me ask you, how many of you that do US partnership returns have gotten a W-9 from US partners? Because you see, if you don't, there's 31% withholding on ordinary income, either pass-through income or distributions, and there's 20% on capital gains. So let's just take this example. Let's say that my son's bicycle shop in Colorado, home of the Colorado Avalanche. Let's say that my son's bicycle shop is a partnership, and he's working on a mountain bike, and I'm doing his taxes, and I walk up to him and I said, hey, Miles, I need one more form from you. I need you to sign this and date it. And he goes, what is it, Dad? I said, well, son, it's a W-9 and you need to sign it. And he says, what's it for? And I said, well, it's to prove that you're a US person. Now, my son's busy. He's trying to fix a bicycle because the customer's on the way to pick it up. And he looks at me and he says, Dad, he says, it's a form to prove I'm a US person? Yes, Miles. And he says, Dad, that's stupid. I said, hey, Miles, you know what? You're right. It is stupid. But you know, I read the instructions of W-9 and it says, even though you're my son and you have a US birth certificate and the whole business, if you don't sign this form, then I have to send 31% to IRS, and you can't afford that. I said, I do your books, you know, for free, as you know, and that you don't have the cash flow for that. So you're better off just taking a moment from the bike there and sign the form. And he goes, okay, Dad. And he does. You and I need checklists, indeed, to show the ladybug tried, to get the information from everybody, to see if we have to push out the K2K3. But also, we need checklists to verify that we have documented whether every partner is foreign or domestic for withholding purposes. And I got one last thing, and we're going to call it, okay? What if, when you're looking at the international stuff for the year 2021, and you're going, oh my gosh, I have to push out the K2, K3, or I have to prove that I don't have to. But what if when you compare 2021 to the past, that you go, oops, we were supposed to be reporting things in the past that we did not report. Now, what do the ethics rules tell the practitioner to do at that point? It may lead to the need for or consideration of amended returns. Circular 230, section 10.21 requires the practitioner to advise the client that amended returns should be filed and the consequences of not doing so. The U.S. Supreme Court tells us in the Badaracco case that no one has to file an amended return. There's no legal obligation. It's just that you might want to avoid the consequences of not doing so. So I cooked up this list of things right here. And the question is, what if we were supposed to be filing these in the past? This relates to foreign financial activity and ownership and so on. What if we were supposed to be filing these in the past and did not do so, for crying out loud? It's the obligation of the practitioner to go to the client and say, gee, we should file these. Now, there may be late penalties, and we're going to have to weigh this out. Filing late reports can, but will at the same time trigger the statute of limitations beginning to run. And if we don't file them, well, the liability item is open for a really long time, known as forever. So if something comes up in the mud puddle because we're paying more attention to international this year, we can't just bury it in the mud. Anyway, there are some programs for coming clean on compliance, some retroactive amnesty programs. But don't try this at home without supervision. It requires the expertise of an international tax attorney that's good at this stuff. And by the way, that's not me. I don't practice getting people out of international tax trouble on a daily basis. I know some guys that do. Well, we're so glad you joined us today. And there's, of course, a much deeper cut, because isn't everything really deep cut and complicated? So I'm going to do a deeper cut on this for Limeberg Information Services. If you care to click into that program, you can register there. It's Friday, June 24th at 2 o'clock Eastern for a couple of hours. And for now, that's it. And I'm so glad you joined us today, and I hope that you got value for your time, and I hope that you enjoyed it. Okay, now, Alan, I can go click on the questions panel here, and if it's something that we would like to do, then I can answer.
Yeah, that's fine, Brad. Go ahead and click on the questions. I'm going to sign off. I'm going to let you finish with the group. For those of you who are CPAs, just know that you're going to get 1 hour of credit for today. Just because my hour was approved. Brad's hour is just an add-on. There's no credit. Brad, you've done a great job. I have really enjoyed it. It's time for me to get home to Marcia. So Brittany's going to make sure that the system works, and I'm going to sign off now. But I can't thank you enough. Very, very interesting program.
Oh, thanks. Thanks for having me, and have a great day.
Yeah, you too. Take care, and goodbye, everybody.
Okay, so I see some questions have come in here, and I'm extremely happy to answer them. Here's one from James. How is a partnership with a number of partners expected to know the international relationships of entities that are 2, 3, 4, or more indirect relationships from the reporting of a partnership at S Corp? In other words, how do you know about your partners? Well, the new law expects you to ask, James. And welcome to the IRS instructions to the K2, K3. They expect you to ask about whether your partners are of foreign ilk. So if you don't, there's big trouble, basically. Okay, let's see. Here's a question by Jesse. If control of Congress changes, will the new Congress get rid of K2, K3? And Jesse observes, I think K2 is a mountain almost as tall as Mount Everest. Gosh, that remains to be seen, Jesse. Okay. Let's see. Here's a question by Megna, and that is, what is the way to prove that K2, K3 does not apply? I think we went through that in the class. My guess is you asked that before I covered it. In fact, I look at the time there. But you actually, I'll just answer it. You look at the IRS FAQs and you find them by Googling IRS K2, K3 frequently asked question FAQ. Google that, you'll find them. You have to find an escape hatch in either FAQ 14 or 15, which in your slide deck made available to you today, I call those Fix A and Fix B. Now here we have Tomer, Jesse, and Rob that all said Dale Hawkins was the original singer of the song Susie Q. A couple of people guessed Buddy Holly, but nah, Buddy's an awesome guy, but he didn't write and launch the song. Okay, James asked, do assets in retirement accounts, not only IRAs and 401ks, profit sharing, defined benefits, need to be reviewed? Well, if the retirement accounts are paying out to pass-through entities, then if it's reported on really the K1, then there's going to be, if it's international retirement account, then yeah, there are some rules that say that IRS also wants you to disclose those on the K2, K3. How exciting. By the way, if you want to Google IRS LBNI, which is Large Business International, LBI, what's called Practice Unit, it's their audit guide, LBNI, like Large Business and International IRS Practice Unit. On the foreign tax credit, you'll find that IRS has charts on what's reportable and what's not. But definitely included in that chart, James, is foreign retirement plan payouts that pass through the pass-through entity. Okay, Hemant has asked this question. If you have minimal foreign tax credit from a brokerage account, does that trigger a K2, K3 requirement? And the answer is yes, if the pass-through entity has paid a foreign tax, even if it's $1, it triggers the K2, K3 requirement. Okay, I have some rather explicative commentary from a very colorfully pronounced participant that I shall not repeat about K2s and K3s. Here's James again. Has the IRS exceeded its authority in requiring the K2 and K3? Golly, probably not, because they used to ask for this stuff on white paper, and now it's just on a form. But they might have, in the sense that they're asking for things to support the foreign tax credit computation. I mean, it's been promulgated without the Administrative Procedures Act. It's just that you'd have to file a court case against them, and that would take 7 years and tens of thousands of dollars. And so if you want to test them, go ahead. Somebody says Ronnie Hawkins, Dale's cousin. The Dale Hawkins, who wrote the original Suzy Q, died a few weeks ago. And Black Mold, a DJ on New Orleans WWOZ radio, plays an original song and version covered by the Rocker weekly on the Friday evening show. So thanks for that, Lewis. Here's a question by Julia. Do we need additional poll questions? No, I think you only got 1 hour of credit. And we got some thank yous here. Thank you all for thanking us. And then somebody said, Lewis says, what's the case you mentioned about amendment return not being required? It's Badaraco, VUS, B-A-D-A-R, Badaraco. What is it? How's it spelled? Just a second. What I'm going to do is go back and search it for you so I can spell it. But it's U.S. Supreme Court, Badaraco. It's in the slide deck that's been provided to you. B-A-D-A-R-A-C-C-O, Badaraco v. Commissioner. It's U.S. Supreme Court. Here's the citation. It's in your materials already. 464 U.S. 386. It's a 1984 case. Badaraco v. Commissioner. 464 U.S. 386. 1984. Okay, got it. Is a green card holder a foreign partner? This is from Sandra. The answer is yes. They are a U.S. resident alien, and that's true. But they're also a foreign partner because they're a foreign citizen, which means their income could be taxed by both the foreign country and the United States. Therefore, they're foreign, and therefore the foreign tax credit could bail you out from paying tax twice. So they're treated as foreign under these rules. Thank you, Sandra, for the question. Hemant asked this. I heard IRS was not geared up to receive the S-Corp K2, K3 earlier. Has it been cleared up now? It's not until late June, and right now we're mid-June. It's, I think, after June 26th or something, as I recall. But that is if they're really ready when that date comes. So they could accept it PDF, the K2, K3 PDF, but not electronic filed, which means if you wanted to file it electronically with your return not in PDF form, you had to extend and do it after the June date if they really come through on the June date. Okay, the Streamline Compliance FBAR link does not work. Okay, so Molly, here's the deal on that. It works for me on Google Chrome or Google Incognito. And I recently put those in and those links do work. So what I would do, if it doesn't work, try a different browser. And if that doesn't work, then take the keywords from the link and type them in and you should be able to find the link. Okay. Steve writes me, and by the way, class, if you're wondering, I've got probably 5 more questions here. Okay. Steve writes this question. I have received Form 1065K1 with wrong allocation numbers, and also the K1 failed to ask the relevant questions regarding foreign activity. I believe an 8275 and a Form 8082 notice of inconsistent position are appropriate. Please discuss. Yeah. I mean, I think you need the 8082 no matter what. And Steve, I'm a big fan of filing the 8275 when there's anything messy on the tax return factually and or legally. And so, yeah, I mean, I love filing 8275s because it takes the penalty off the table. So I routinely file them, sometimes with the 8082 attached. I couldn't agree more. If you have the gut feeling you should disclose as a messy factual or legal position, and here it's going to be a factual position, then definitely I think that's a good plan. Okay, here's Abigail. I guess you can keep submitting questions, class, if you want to. Here's Abigail. If a partner or shareholder files for the 1116, must the K2, K3 be filed? Yes, if the partner asks you for it. So Abigail, here's the deal. We all know in 2022 that we all have to file K2, K3 no matter what. But for 2021, you might get transition relief. But the deal is, just a second.
I'm sorry.
15 minutes, thanks.
Okay. I'm sorry.
Hey guys, I'm in a Hampton Inn. I got a late checkout legally, okay? And the maid just came in to clean the room. So there, and it happened live. Isn't that exciting? Okay. So I'm back. If a partner or shareholder files for 1116, must the K2, K3 be filed? If the partner has asked for the information, then yes, you must file the K2, K3 every time. But if they haven't let you know that they need the information for the 1116, you may be off the hook for supplying the information on K2, K3 if you follow the ground rules from FAQ 1515, which I call Fix B. So it depends. Very nice. Okay. Some nice comments from some very nice people here. Must take QK3 be filed if a U.S. partner has an 1116 filing requirement due to mutual fund dividends? Well, it'll help the U.S. partner to have the information that would be supplied on a K2, K3. So if the partnership or S Corp has followed escape hatch I call Fix B, and no one has let the pass-through entity know that a K2, K3 is required, the partnership may be off the hook for filing the K2, K3, but then the partner in question here, Lewis, in your question, can come back and bug the partnership, which is not what they want, to be bugged for things like that. So it's better that they push out the K2, K3 originally and be done with it and move on with their lives. Better for them, more efficient. But the question is, if the partnership met all the requirements of Fix B, which is IRS FAQ 15, then they don't have to file it, but they will have to come up with the information later. Now here, music trivia buff Tomer says the band also played for Ronnie Hawkins before Bob Dylan and then becoming the band. Really? Oh, that's fantastic. And then we've got one more. It says, if you have not collected a W-9 in past years, is it sufficient to get it going forward? Well, it's the best you can do. So is it sufficient for the past? Probably not. But what if you have them sign a statement at the same time? Now, don't backdate the statement, but what if you have them sign a statement at the same time that says all of our partners have always been U.S. partners. I've always been a U.S. partner, and this is retroactive way back to the beginning, that it's effective that I've always been a U.S. partner. In other words, you could try something like that. You don't backdate it, but you say, effectively speaking, I've always been a U.S. partner. And if you make that, you can take the W-9 language and put that into the statement they're signing, all the key language that operably protects you. I would do that if you're worried about it. But don't backdate it, because that's lying about stuff. And Alan would tell you in his relationship seminar that that's a bad thing to do. Okay, I think that's the last question. Oh, what a kick this has been. So, on behalf of Alan Gassman and his outstanding law firm, and CPA Academy for that matter, I'm Bradley Burnett signing off. If anybody has a last question, pipe it in. I'll give you a second or so. Okay. So glad you joined us, and I hope you received value, and I hope you enjoyed it. I'm Bradley Burnett signing off.